PayPal stock. Guys, in full disclosure, I own PayPal. This doesn't mean you should go buy PayPal. Ever, ever, ever. Don't buy something just because somebody that you watch or you listen to owns it. What I'm trying to do is teach a process here. I'm trying to teach you how to fish because at the end of the day, you want to be able to learn how to make your own decisions. I don't agree with every value investor that I respect. And there are times they buy stocks and I go, what were they doing there? I have no idea. I don't see it. And guess what? I don't buy it. That's the sign of getting confidence in yourself. And that's what I'm trying to teach here. In this video, we're going to go over PayPal. We're going to go over some beginner investment ideas and some more advanced ones. Wherever you fall in the spectrum between beginner and advanced, there is something in this video for you. We're going to go over some news, some bull and bear cases, analyst estimates, of course, our 8 pillars. We're going to cover those because that is really what we use here as a screening tool. And then we're going to finish by using the stock analyzer tool, which is our most popular part of our software, to determine a price based on our assumptions about the future. So let's get into PayPal and take a look at some high-level things. First off, all-time high for PayPal. July 26, 2021 at 310. Now, guys, we had our channel back then. I encourage you when this is all said and done to go take a look at what we said about PayPal. We were probably like, yeah, avoid this. Because remember, guys, we believe that every investment is the present value of all future cash flow. And when you buy a stock, you're buying a piece of a business. But the stock price and the business are very different things. The business fundamentals can be awesome and great, and if the stock price is through the moon insane and you can't justify it, you should not buy the stock, even if you love the company. That is very important as a way of being an investor. You've got to be able to realize that the stock price is just people's emotions about the company. That's it. It doesn't actually reflect the company at all times. Your job as an investor is to find a disconnect. All right? All right, so market cap of PayPal is $82 billion. That means if you bought every share of PayPal outstanding, it would cost you $82.33 billion to own 100% of the shares. They made about $2.7 billion last year. Now, here's the interesting part. Free cash flow was $5 billion. Big difference, which I love. That's a big difference. We love it when the free cash flow is larger or very close to the net income. 5-year average free cash flow, very consistent, $5 billion as well. Now, 30 PE. Sounds expensive, right? So you're probably wondering, well, why does Paul own this company? Well, first off, I bought it a lot lower than 73. I was buying sub 65. And guess what? I hope it goes to 50. That's what I want you guys to remember. I don't look at 70. I look at this and go, oh, that sucks. So if you're new to hearing that, subscribe to the channel because I want you to realize that I get upset when stocks that I believe in go up. I want them to go down so I can buy more shares. The stock market's the only place in the world where when things go on sale 25, 50 or more percent, people actually don't want to buy it. Now remember, not all stocks that fall are a great buy. But for those of you out there who love the company at 310 and don't love the company at 72, I would ask you, are you really an investor? And I'm sure that's not you watching the video because people who would not agree with me here probably aren't watching our videos. Okay, a couple other things. This return on invested capital. This is an important metric for investing. It basically says when the company invests money into their business through debt or equity, what kind of return do they get? The market average is 9 or 10%. So it's not much different than the market average. But PayPal is still a growing business. And growing businesses can have much lower ROICs, return on invested capital. As an example, Apple, which is a very mature business, has like a 38% return on invested capital. Yeah, but they're very mature. They're not reinvesting back in the company a ton because how do they grow that business a lot? It's hard, right? So this one, even though it's above my minimum, it's not a great number. I'm not worried about it. Gross profit, almost 50%. This means every extra dollar they bring in revenue, almost 50% of it goes to pay taxes and their overhead. That's an incredible number. And the profit margin of 9.6 versus their 5-year average of 14, something to consider. Why is it lower in the last year than it has been over the last 5 years? No dividend, which makes a lot of sense. So, okay, overall, some things. Now, let's go over a couple of pieces of news about PayPal. First off, they're introducing tap to pay for Venmo and PayPal overall. You guys go to the thing, you tap it, boom, you're paid. Remember, PayPal owns Venmo. I love Venmo. I trust PayPal immensely. This is why I'm a buyer of the company, because once it fell back down to reality from 310 to someplace else, I look at PayPal and think, for me, PayPal is a source of comfort. It's a source of, I know that if I buy something from another country through PayPal, if something goes wrong, I'm getting my money back. And that's extremely important when it comes to money. That trust factor is very important. Another one, PayPal and KKR announced a multi-year relationship for European pay later receivables. What that means is PayPal will allow people to pay later in Europe, and they're going to sell that note that they have. So they sell you something, and you pay $100 for it, but you don't pay them day one. They're going to take that $100 that you're paying them in the future and let KKR buy it from them for some discount to get that return. That's a big deal. KKR, they're a big asset management firm, and their goal is to buy good investments. And some people buy receivables. That means PayPal's receivables, money that people owe them, are being sold to KKR so that so PayPal can get money day one and KKR can get a return on their money in the future. All right. So a couple of bull cases for PayPal. They're pushing to reduce operating costs with margins of 22.7 in Q1 2023. They want to grow their margins by 100 basis points, which is 1%. And that's a big deal, guys. And they want to do that by the end of this year. You might hear that and go, 1%, that's it? That's pretty big. Look at it this way. On $28 billion in revenue, that's $280 million. And you multiply that by a 20 PE, that's $5.6 billion in extra value for the company. Okay, so 1% adds up quite a bit. 1% on that 28 billion and growing adds up quite a bit. Another one, they expect to spend $4 billion of its $5 billion in free cash flow buying back shares. Now remember, buying back shares is important only if the company is buying back cheap shares. And even though this 30 PE is here, we don't know if it's cheap or not just based on this. Because remember, if a company has a lot of growth potential and a high return on invested capital, you can pay a much higher premium for the company. It makes their cheap price a lot higher. Why? Well, think about it this way. If you have two companies, they're exactly the same today, make $100 each, but one can grow at 20% a year and one's going to grow at 5% a year. Which one should you pay more money for? Of course, the one that's going to grow at 20% a year. So I love the fact they're going to buy back shares. $4 billion is 5% of their market cap, which means if you own their stock, they did this every single year, you own 5% more of the business than you did before. That's a huge number, and it adds up over long periods of time. If you do that for 20 years, they're going to buy back all the stock in the company, right? Now, obviously, they're not going to do that, but the point is that's how you can get a lot of shareholder value. That's how you can drive up the price of the share, because now you're splitting the profit and cash flow amongst less shares as time goes on. So if you just keep your shares and just ride it out, your stock price will go up as long as they're buying back good, cheap shares. All right? Now, a couple of bear cases. Due to stock-based compensation, which is when they issue shares out for people in the company as a way of compensating them, their earnings per share has fallen from $4.13 to $3.26. Now, what does that mean? So, guys, a lot of investors will sit there and say, listen, if you're issuing stock, you have to expense that, because if you're paying people out money, what is it? You're basically incurring some sort of cost. Now, a lot of people will calculate free cash flow and earnings after stock-based compensation. So that's a very realistic and reasonable assessment. If the company makes $5 billion, but they issue $5 billion in stock-based compensation, they're essentially making $0. Essentially is what the way to look at it. There's no cash flow, right? So that is a thing I don't really like a lot, but PayPal is an up-and-coming company, so they're probably trying to use stock to get people excited. Another bear case. Since 2020, the CEO of PayPal sold off 280,000 shares of stock. Now, people sell stock for a lot of different reasons. I would look at that and say, hey, is it more than usual? Because a lot of CEOs, Jeff Bezos, Bill Gates, all these guys will sell regularly as part of a plan of diversifying their funds. So that's something to consider. I don't like it when I want to find companies that the CEOs and the higher ups have a large part of their net worth attached to the company. Right? Because think about it. If somebody's worth 50 million bucks and all 50 million is in one company, you better believe they're going to do absolutely the best thing for that company, right? That's super, super important. Now, let's go check out our 8 pillars on PayPal. Oh, wow. Now, guys, remember, if you have our software, you can customize your pillars, and it doesn't have to be 8. You can go up to 12 pillars, and there's like 4 quadrillion different variations of this. But so right now, the 5-year PE of 26.4, but look at this. The 5-year price of free cash flow is much lower. So they're reporting higher free cash flow than net income, which I like. And the one X right here, the second X is cash flow is down about $1 billion over the last 5 years. Let's go check that out on the cash flow statement. So remember, guys, free cash flow is cash from operations less your capital expenditures. Now, a company like this, look at how little their capital expenditures are. They don't have to keep reinvesting over and over. Now, they probably are because they want to grow and grow and grow, because look at their income over the last 10 years. They had $1.9 billion in revenue in 2014, and now they have $28 billion. That's some massive growth. And of course, during COVID, look at the big jump, 18.3 to $23 billion in revenue. So big jumps there, guys. Now, again, there's a lot of competition in this space, but PayPal still, I believe, the trusted name in this. Now, there are other Amazon Pay's trusted, but I look at PayPal saying internationally, this is a company when it comes to financial transactions that people trust a lot. All right. Let's go see what analyst estimates are for this company. They're expecting the company to make $5 a share this year and expected to go to $9.22 in the next 4 or 5 years. So double-digit growth all day here, according to analysts. Now, remember, analysts have the same biases we all have. Just remember that. And they want to be in the ballpark as everybody. So keep this with a grain of salt, especially as you go further out. In shorter time periods are more accurate, but they're also adjusting those estimates as time goes on, even up to the day before the actual reporting of financials. So what about revenue growth? Not as fast as EPS, but still pretty solid, 30 billion to 46 billion. That's an increase of 50% over the next 1, 2, 3, 4 years. That's big time money, guys. That's good stuff, according to analysts again. But still, it's nice to see these things happening. So let's go do the stock analyzer tool, like I said before. Now, guys, this stock analyzer tool, there's a reason why it's the most popular part of our site. It allows our users, not including the balance sheet, to make assumptions about the future, because every investment is the present value of all future cash flow, and we don't know the future. What's important here is you guys listen to this entire video through the end. I want you guys, because I will do my estimates, and I will explain a few numbers here, but it's important, especially if you have our software, to be able to understand how we use this tool to maximize our decisions today. So if you like this and you like all of our tools here, there's all these other tools coming, especially the real estate calculator, which is available, which will be grandfathered in. If you sign up today for our software, you get this real estate calculator, because pretty soon it's going to go on its own separate thing. And you have the Everything Money community. Thousands of people talking every single day, exchanging thousands of messages, talking about investing, because investing can be a lonely road. And we want you to have like-minded people. Now, people in that community, some of them like Tesla, some of them like crypto. It's a very wide range. But the point is, we all talk about things in the same way, but we're going to evaluate things differently. So if you're interested in the software, everythingmoney.com, we're running a special, $7 for 7 days, $1 per day. You get all of these tools and all of the software. Go sign up. Guys, years of analysis. We can do 1 to 20 on the software. I'm going to do 10 for PayPal. So my first order of business, what is my revenue growth that I'm assuming for the future? I'm going to do low, middle, and high. So I'm going to go with 4, 7, and 10%. Okay? It's a wide range. But the reason being is 4, they should be able to do all day with a growing economy. 10 will take some effort, but could they do that? Sure. That would take their revenue from 30 billion to $70 billion or something like that. All right, that's a possibility as they grow, as the world becomes more and more financially, using more financial transactions on the internet. So they could definitely see that happening. Some might even put here 4, 8, and 12, right? Could happen. I just don't know I don't know exactly what's going to be out there, but the point is to make a wide range here so you can see where this company falls. Next one. Okay, how much money are they going to make on that? What's their profit margin going to be? Over the last 10 years, they've averaged 13.5%, last 5 years, 14, and last year, 10. So I'm going to go with 11. No, I'm going to go 10, 13.5, and 17. There could be more competition here that makes margins go down. but they could also dominate this even more and become more of the reliable one, and margins could go up, especially with such a high gross margin of 50%, if you remember before. Their gross margin is 50%. So if all of a sudden they doubled their transactions, they probably don't have to increase their overhead by that much, so their profit margin will go even higher. All right? Free cash flow. Now, guys, look, their free cash flow is always significantly higher than their profit margin. So I'm going to go with a higher free cash flow number. Now, let's go 7, 16, 21, and 26%. Much higher levels. But again, like I told you before, they averaged 21% here over the last 10 years. So I'm good with this. If they do a little bit worse, fine. The goal here is to be low on the conservative side, high on the high side, but both are still things that could happen within a reasonable percentage. I don't know what percentage that is, but the whole point here is to give you that range of values. Now, what should the PE and price of free cash flow be at some point in 10 years? Well, guys, the way I always do this is this. I start with a market average of 15. And with higher growth and higher ROIC, I go higher. And with lower growth and lower ROIC, I go lower. So here, there's a lot of growth potential here. I'm going to go with 14, 17, and 20. Same with the price of free cash flow. Now, the hard part about price of free, since the free cash flow is so much higher than profit margin, it's kind of hard to determine really. But again, this is the reason why you should get the software and do your own numbers. This is why in the community, people are always sending screenshots of their stock analyzer tool. And this is why it was used 1.3 million times last year. So finally, desired return. What's the return you want to get? You can get 9 or 10% by investing in a low-cost ETF. So you have to decide for yourself, what's your margin of safety? That's where you put that here. The higher your return, the higher the margin of safety. If you want a 10% return, you'd pay more than if you want a 20% return, right? So the higher the desired return, the more margin of safety. Now for this one, I don't think it's the company of like a Microsoft where I'm okay making 9 or 10%. I think I still need a little extra meat on this bone. So I'm going to do 12. I'm going to do 11.5, 13, and 14.5. Now guys, when I hit the analyze button, I'm going to get a bunch of numbers down below. Please stick with me through this entire video so I can explain these numbers. Ready? All right. I got a low price of 33 to 53, a high price of 87 to 133, and a middle price of 56 to 87. Now, why such a big difference? Remember, their free cash flow was much higher than their earnings value. All right. But here I'm looking at this going, okay, now you see why I have it on my watch list at $60. Because even on the earnings perspective, if I can buy it here, if I bought it today at $73 and the low assumptions occur, I'm going to make 7%. If I bought it today and the middle assumptions occur, look at this, 15.67%. And if the high assumptions occur, grand salami. Again, this does not mean you should go buy it based on this. Do your research. It's a good starting point to say, hey, these numbers look good. Let me go do more research. So if you want to do more research, a great way to start, sign up for our software, everythingmoney.com, $7 for 7 days, and talk in the community about PayPal. Thank you very much for your time.